Good morning, everybody. Thanks for joining us for the Thursday training session. We're going to begin in just a moment here, but if you guys do have questions, you want to enter those into the questions area in your GoToMeeting toolbar, and we'll address those as soon as they come through. You guys should be seeing my screen momentarily here if you're not seeing it already, but if you would, go ahead and pop those questions into the questions area, and I will try to address those as they come in. Thank you very much, guys. We'll start in just a moment here. Okay, so I don't see any questions coming in through the toolbar yet, so I think what we'll do is we'll start working on a couple of basics here, and hopefully that'll prompt some questions. So at this time of the year, a lot of you are probably doing your annual mortgage reviews, so I think we're going to start covering that first. So there's a couple of ways you can set these up, or actually to get the data in there's a couple of ways. One, you can import a Fannie Mae file, and you can get those off your loan origination system. That's a really easy way to do it because you've already got the closed loan data already in that Fannie Mae, and when you bring it in, you can bring it in without having to do a whole lot of data entry inside Edge. So let me show you what that would look like. So I'm going to start with a brand new client, and then I'm going to hit the import button down at the bottom here, and you can see I've selected Fannie Mae. And on the drop down, we have the option of what type of import we want to do. Do we want to bring this in as a proposed mortgage, or do we want to bring it in as a current mortgage? Now in this case, since we're doing annual reviews and this mortgage is in our system, it closed a while back. So we want to bring this one in as a current mortgage. So I'll hit current mortgage and hit OK. Now you'll need to search for the Fannie Mae file at this point. If you haven't already exported it from your loan origination system, it's actually fairly simple to do in Point. It's a little harder in Encompass because you have to go to the Access Lenders area and you have to choose the Fannie Mae format rather than accessing a direct lender. But if you guys need a video on that, I did build a video on it not too long ago that I'd be happy to send out to you to show you how it's done. But if you need that, send us a quick note over at support@mortgagecoach.com and we'll get it over to you. All right, so let's assume you've got your Fannie Mae file already on your desktop, and let's see if I've got one. Yeah, there it is. Closed loan demo. This is just a regular Fannie Mae file, and you can see when you bring it in, it brings in some basics. It brings in the first name and last name, home phone number. It does also bring in contact information, and you can see I've got my property address here, and I have an email address in that Fannie Mae file, so it brought it over as well. Now back on the client screen, I think the last thing I need to do here is I want to make sure and put my my friendly name in here. I'll just call it Annual Mortgage Review. And then on the goals, the only one I'm not going to choose is the purchase goal. The purchase one will eliminate the use of the current mortgage, so we don't want to do that. We can choose any of the other ones. So we'll try lower interest rate. Now you can see that it brought over the original property value and the original appraised value too. So these are usually one and the same, but when you're revisiting an older loan, it may have appreciated. So if it has appreciated, you can put in the new appreciated value up here, and the original appraised value will still be what the LTV cutoffs are based on for your mortgage insurance. So that's why this one's important to have. If you find that you're trying to do a current mortgage that has mortgage insurance, but their property is appreciated and they're now closer to the 75% mark instead of 80, Edge is not going to apply that MI because you haven't, you've got a 78% cutoff on it. If that's the case, just make sure to put the original appraised value in this line here, and your MI cutoffs will be based on that figure instead. Now as I go into the assumptions, you can see what got brought over here. This was all brought directly from the Fannie Mae file, so I didn't have to do any data entry at all. The only thing I'd want to do is verify that that payment looks right. If they've told me they've got a different remaining balance, if I've talked to them recently, or if I know that they've made additional principal payments, because that's the way I originally structured their loan, then I'd want to update the remaining balance. And if that's the case, you can simply overwrite it, and it'll adjust the freedom point accordingly. Now I didn't have any hazard or taxes on my Fannie Mae file, so I'm going to need to make sure and enter those. And because I would probably actually have the real figures somewhere in my loan origination system, I'd probably want to put those in as dollar figures rather than percentages. But for today's study, I'm just going to use percentages. And let's take a look at what our LTV is. Let's make sure we're not requiring MI. So you can see our LTV on this one, 78.27. So it doesn't have MI in it, so I don't need to go and hunt that down. So I can go back to the last part of my assumptions here. I'm going to leave the mortgage insurance blank. And then when I hit the right arrow, it automatically brought in their annual gross income for me because that was in my Fannie Mae file. If I wanted to enter additional liability debt, I can do that right here. And if you want to show them their tax benefit, you must enter a tax bracket here. Without the tax bracket, it won't know what to use for the tax benefit for you. So if you do want to show that, make sure and pop it in. Let's say they're in the 25% bracket. Now, the affordability goals, you can bypass these if you need to. These, especially on an annual mortgage review, we really don't need to put anything here. And now all we're going to do is we're going to show them a couple of new potential options. So we've got their current mortgage in there. We don't have to worry about that one anymore. We've got a full pity payment showing here. So now we're going to do our new products. So let's say new 30 fixed. And all I'm going to do is I'm going to toggle the refi switch over to yes. And when you do that, it automatically brings in what they owe as their new base loan amount. So if I did nothing from this point on, this would be a straight rate and term refi, no cash out, no cash due. Now obviously we're going to have closing costs on here, and because we're so close to that LTV threshold, we may not want to roll them in, but we'll have to see what it looks like. Now interest rate, let's say I can get them 4.5 right now, and my term is 360 months. Now I'm going to put in my hazard insurance and my taxes real quick. The reason I'm doing that is I want to see what the pity payments look like against each other, so I know where I'm at. Now you can see in this particular case, I'm not saving them a whole bunch of money. I'm saving them about 70 bucks, but this still may be a viable option for them. Now what's really going to make the decision is whether the closing costs are going to be so much that the $70 savings just doesn't make a difference for them over the long term. But the idea behind an annual mortgage review is even if it's not beneficial for them to do a refi right now, you still want to show them this. This positions you as that trusted advisor that revisits their mortgage every year and says, hey, I'm showing you what's out there. It may or may not be what's good for you right now, but I want you to see what's out there so that you know when something good is out there, you're guaranteed to know about it from me. So I'm going to plug in one of my closing cost templates here. Let's do a conventional 30. And I'll edit the variable costs. And this one is, it's kind of a high value loan. Let's say it's about $5 grand. And then I'm going to apply those to the loan. Now let's check it out and see what this looks like. So I'm saving them $70 a month. And if you look at the current mortgage, and of course my short-term months are at 600 instead of 60, but you can see at the 60-month area, at 5 years, we've broken even on the closing costs, and we've saved them an additional amount of interest that would net them a $2,000 savings. Now, to find out where exactly they're going to break even on those closing costs, we're looking for where the savings shift from the current mortgage to the new mortgage. So let's take a look at somewhere around year 1. And actually, at year 1, we're still in the clear. Let's see what we look like at 36. We're not saving a whole lot. Let's check it out and see what we've got. So the whole reason behind this is we're going from a 4.5% interest rate to a new 4.5% interest rate, and we're actually starting over in the mortgage. So technically, we're having a problem because we're asking them to pay closing costs. So let's go and revise our product. Let's say that we can get them slightly better. Let's say we can get them 4.25%, just so we have a little bit of a savings to show them. All right, there we go. And let's check out our analysis now. So that looks a little bit better. We've got a good monthly savings that we can show them, and it looks pretty solid here. So at this point, I probably would send this review out with a recommendation to do a refinance, because now I'm looking at a $6,000 savings over the 3-year period of time and a monthly savings. So I can even show them how to reinvest this and pay off their mortgage faster. So I think what I'll do is I'll actually copy that product into a new slot. So let's go to the last screen of that 30 fixed. I'm going to add one more product, use the copy button, and I'm going to copy that 30-year fixed. Then I'm going to go straight over to the analysis screen. I'm going to go to the adjust reinvestment area, and I'm going to earmark that 162.61 to go straight back into their mortgage. And you can see that by doing that, we're shortening their freedom point now. We're at 27.17 years versus the 28.67 that they currently had. And by doing this, obviously, we're saving them interest over time as well. Now all I've got to do is really go back and name this second product. So this one's going to be 30 fixed with reinvestment. All right, so I've got some solid options next to each other, and when we get to our presentation screen, I'm basically going to need to edit my payment notes. So I'll come in here and just let them know that taxes and insurance are included in the payments. And then if I needed to edit any of this sidebar text, you guys should have default text here. I've erased mine at some point, but you can put any kind of text you want here just to let them know what these payments are. Maybe even you want to put a little bit of color around what this monthly savings reinvestment grid is. And then you're going to want to look at your short-term and long-term areas and edit any text in there that you see fit. And then the last thing, make sure to give it a quote date. After all, this is an annual review, so we want to make sure that they know when these rates are valid. And then you're going to generate your link. Now once you've generated your link, you're going to copy that, start up a brand new email to your client, and I'm just going to paste it in there for now. And I'm going to put that aside. Now the next step here is, because it's an annual review, I want to make sure that I can explain this to my client and that they understand what I'm trying to show them. So I'm going to hit Add Audio Video, and that's going to bring up the video recorder. And that's what we should have been seeing earlier. Those are the right figures there. I was running into a cache problem inside my browser that was showing like a lot more savings than that initially. So some of you may have caught that. But these are the correct ones now. Now the last part here is I want to navigate the report and just check out what it looks like from all angles so that I know what my client's going to see. So I'm going to go into the More Info sections. Just make sure everything looks right here. My pity payments look correct against each other. You can see my reinvestment here of the 162. If I look into my closing costs, I can go into the fee detail and just make sure everything's earmarked correctly. And then I can go into my reinvestment grid. And one thing you can also do while you're in here taking a look is you can highlight things. Whatever you left click on is going to highlight. So if you want to leave something highlighted for your borrower to draw their attention to it, something like this, I would probably leave that one highlighted. Now the More Info on the top right, there's not a whole lot to it. This is just a basic breakdown of what the loans are and what their payments result at. It does show the property appreciation that we're using over time, and it also shows our tax bracket. Now you can see that our tax benefit is also shown between these new ones. So we had a little bit higher benefit on the current mortgage, and that's just because we had a little bit higher interest rate. So the net benefit to the borrower, they're going to get a little bit less benefit moving to a lower interest rate. But it's not so much that it would make a big problem. When we look at our More Info section here, you can see what our tax benefit is over time between each of these. It's about a $2,000 difference, actually about a $1,000 difference over the 3-year period of time. So not huge, since we're saving them, $6,000 and $6,100 on these new options. Now lastly, I want to go into the interest in MI, take a look at it. You can see what my total tax benefit is over time. I can actually unclick these, and you notice that when I unhighlight those, it unhighlights everywhere that tax benefit has been highlighted. I'd probably want to show them this $29,000 total reduction over the 15-year point. That's how much extra principal that they will have paid from doing that $162 per month. That's going to it's going to drop their loan balance pretty significantly. You can see that we're looking at $368 versus $409. Now last step, if you've never ever done a video in Edge before, you'll need to do a couple of things to get set up before you can begin recording. What you do is just right click anywhere on the presentation here, and you're going to hit Settings. Now you'll start off at this screen on the left. You can leave this checkbox checked, Enable Hardware Acceleration. The only time you'd want to leave this unchecked is if you find that if your computer is about, I don't know, 8 or 9 years old, it's got a really old video card in it, and it can't support video recording, you'll know it right away because you'll have the choppiest video in the world. If that's the case, come back in here and uncheck the hardware acceleration box, and it should be a little bit better for your video card. It should be able to handle it a little better. Now the privacy, you want to make sure to check Allow, and then click the Remember checkbox so you're not asked every time you try to record. Local storage, you can leave it as is. It doesn't really matter what you choose here. Usually I choose one of the higher ones just in case, but it's up to you. You don't really need to do that. Now the most important parts here are selecting your microphone and your webcam. Now if you've got multiple microphones on your machine like I do, I have a bunch of them, so if I don't select the right one, I'm going to be talking into the wrong device and it's not going to capture correctly. Now most webcams nowadays do have a microphone built in. So if you've got an external webcam, you're probably going to be choosing your external webcam for both the mic and the webcam. Now if you've got a laptop that has an internal mic and an internal webcam, it'll look a little bit different. Mine is internal as well. You can see I've got one called Microphone Array. That is the mic that's built into my laptop. I've got my laptop on a dock right now, so there's no sense in me trying to use that. The lid's covered, so it won't pick anything up. So I would use my my webcam for this. So I'll select that. And then you want to just talk into it a little bit. Make sure that your meter bounces when you're talking, because that'll let you know you've selected the right device. And lastly, you want to select the webcam. Now, if you're like me on a laptop and you've got an integrated webcam, you'll see it there called integrated webcam. If you've got a plug-in webcam, you'll see it there as a different name. So I'm going to use the one that's plugged into my USB ports instead of the integrated one for today's discussion. But you can always jump between these if you need to. If you find that you get a little bit better resolution on one of your cameras than the other, feel free to jump around and test these out. All right, so now that I've got that set, last step here is start the recorder. So I'm going to pull that up, and I usually like to bring it up to the top of my screen. And the reason for this is I like to put little bullet points right behind my webcam. When you do that, it allows you to keep eye contact with the webcam a little bit longer. You don't have to look around the report to try and justify where your numbers are coming from. You're just going to want to go through the bullet point list and really make it seem like you're sitting across from your client having coffee. So in order to do that, like I said, grab a little Post-it, pop it up right behind your webcam, and literally just put up a bunch of bullet points right there. That way you won't stray with your eyes. You'll have a focus. You'll have a meter, which is a lot easier to control than just trying to wing it. And then you want to keep it short. You want to keep it about 2 minutes or less. Anything over than that, it's a little bit superfluous. You're going to lose people's attention a bit. Under 2 minutes, generally you're going to keep their attention for the entire video. So the idea is you want to touch on some basic points during your video, and then you want to have a good call to action at the end so that they know to call you so you can go into this in further detail. Now, of course, the magic of the video is that it accompanies this presentation wherever it goes. So if they choose to share it with a loved one, they choose to share it with one of their friends, if they want to post it on Facebook, anywhere it goes, at least you know that your video is going to go with it, so it will have your explanation accompanying it. All right, so last step is hit the record button, and then as soon as you see recording, and mine says no access to record, let me tell you how to get around this problem. Anytime you see a no access to record, it's because of one of two things. Either you're recording in two different windows at the same time and they're blocking each other out, or the license files in your browser have expired. And all you have to do to fix this, right-click anywhere in the browser, hit Global Settings, then you're going to hit the Advanced tab, and then you're going to hit the Delete All button. Now there's two possible items to delete here. You don't want to delete all the site data and settings, but you do want to delete the audio and video license files. Once you've got that checked, hit Delete Data. It does it right away, so you won't have to worry about it. And then you want to close out of your video recording window. You actually may need to close the browser entirely. We'll find out if we have to do that right now. But let's see. Okay, so yeah, I would need to close the entire browser in order to make that clear go. But if you ever run into that, that's the way to fix it. Just right-click anywhere in here, go to Global Settings, click the Advanced tab, delete all, and then check the bottom box here. You can do the top box if you want, but you're going to have to set up your webcam and microphone again if you do that. But it's up to you. It's not that hard of a process. And Shannon, hopefully you got that. I just repeated that, but let me show you guys one more time, because I know a lot of people do run into this quite often. Right-click anywhere on the screen, and this is your recording screen here, and you're going to hit Global Settings. And that's going to bring up your flash recorder settings. So at this point, you're going to click on the Advanced tab, click on Delete All, check the bottom box. It's up to you whether you want to check the top box or not. Then hit Delete Data, and then you can close this guy out. You'll probably need to close your browser and reopen it so that it applies the changes, and then you should be able to get around that error. All right. Perfect. So it looks like we've got everything on that annual mortgage review all set up. Now remember, it's okay if the mortgage review doesn't look good to the client, meaning they've got a 4% rate and you're offering 4.25 right now. Show them that. I mean, it makes perfect sense. You're still looking out for their best interest, and even though you can't get them a better rate right now, you want to show them why it was such a great time to trust you last year. You know why they made a good decision in the past. It's just going to reaffirm what they think they had in the transaction with you. Steve's question, he says, how do we get help figuring out why my APRs are so far off of my reports? Steve, we'd have to see one of your presentations and one of your fee worksheets from your origination system to find out what that is. But I will tell you, if you're finding that's happening a lot on FHA loans, I can almost guarantee that it's the MI cutoff box here. So for instance, if this guy was an FHA, and you know that this does have to carry for 360 months, it's got to go to the life of the loan. But what you may be missing is you may be missing this box right here, Calc MI on balance. What this does is this forces the MI payment to decline over time based on the last 12 months outstanding balance. So this eventually, towards the end of this loan, is going to be like a $25 mortgage insurance payment. Now, mortgage insurance is part of the APR. So if you don't check this box, it's going to mean $700 per month. That's going to boost your APR really, really high. So if you're finding this is happening mostly on FHA loans, come back in here, make sure that you've got this checkbox and you've got 360 right here. And that should tear your APR way down. But if that's not the case, feel free to send it over to us, Steve, a link to your presentation and then a fee worksheet that came out of your origination system so we can compare them, and we'll get it isolated for you. All right, so I don't want that as part of my mortgage review here, so we'll pull that out of there. All right, so let's get to a couple of other things. So we've done our annual mortgage review. We've accompanied it with a video, and we're ready to go out. So remember I said that I'm just going to copy and paste that link into my email here. Now, the next step, obviously, get your client's email, give it a good subject line, and just write out a brief blurb about what your annual mortgage review service is. You know, what are you trying to show them with this video? You might want to even give it a little color on how you think they should proceed. For instance, if you've issued them a mortgage review and the new mortgage you're proposing is actually a higher rate or no advantage to the borrower, well, in a case like that, you'd want to let them know that. Talk to them about it, give them some color around it, let them know that you're going to send these to them every year, and if they want additional reviews, to just shoot you a quick note, and you're happy to do it for them anytime. But one thing I get a lot of questions coming through the box, so I try to show this as often as possible, is how do you change this link? Normally when you email this to your client, the client looks at this and says, okay, I have no idea what this link really is. Obviously you can put some good color around it with words to let them know what the link is, but what if you just want to mask it? So the way to do that would be write the text that you want to use. So click here to view your annual mortgage review. And of course, make sure you've got it spelled right and everything. Now I'm going to copy this link real quick, and I'm going to select the text that I want to turn into a link. I'm going to right-click on it and hit hyperlink. Now once you do that, you'll see that the text to display is up top. You can change that if you want. That's going to change this text right here. But where do you want it to point to is this part right here. This is where you're going to literally just paste your edge link in there and hit OK. And when you do that, you've now turned this text up here into a clickable link. So if they click on this guy, it's going to take them directly over to your presentation along with your video. Now you don't need to have this guy in your email anymore. So you can put as much color as you want around it. It doesn't look like, there's nothing odd in the email to your client. You've got a better chance of getting a click on this if you do mask the link just like this. Okay. So I don't see any more questions in the box just yet, so I think what we'll do is we'll get back in and we'll do a new client real quick. And we'll just show a couple of purchase options, and I'll show you a couple of more detailed loans. We'll do an FHA loan, and we'll do an adjustable rate mortgage so you guys can see how those are done. So this one's just going to be a sample file. And I'm going to make this a purchase. Now, depending on what you want to do, if you choose rent here, it's going to try and walk you through the rent versus own report. You can choose the total cost when you get to the end. However, your analysis screen is going to reflect rent versus own values until you actually generate the report. Then your report will reflect the TCA. But if I just want to have it to be a TCA from the beginning to the end, the easy way to do it is click own and then click the purchase goal. So this won't ask you for a current mortgage. Doesn't really matter if they own or not at this point. You just want to make sure that when you go through the wizard, it's going to be a total cost the entire way through. So current property value, this is really, you don't even need to enter it on a purchase, but it's going to make it a little bit easier on the data entry for the products because it'll automatically pull in that value as the purchase price. So let's say this was $250. And I am going to show their tax benefit. Say they're 28%. Now, if you were doing the MCC credit, you can go into tax credits here, and you can tell Edge exactly what you want to use here. Basically, how much of that percentage can they deduct, and what's the cap? I know here in California, they can deduct up to 30% of the annual interest, and it cannot exceed $2,000 per year. So now that I've got that in there, that MCC credit is going to be available on any new purchase products that I choose. So I'm going to go straight into my first one, and you'll notice that there's a new area down here that says Apply MCC Credit. You can now apply it per loan program. This is something that we put out not too long ago as a fix, because it used to be that if you had the MCC credit in there, it did it for all loan programs. Now you can do it on a per program basis. So for this one, let's say FHA with MCC. We will change this over to be an FHA loan. Very important because it's going to open the upfront MIP field for us. We'll put in our down payment, the interest rate we can get for them right now, and our term. Now I am going to apply the MCC credit to this one, so I'm going to make sure and check the box here. We'll pull in our closing costs. And remember, on your fee worksheet, you would normally see your mortgage insurance premium as a line item, but you're not going to put it as a line item in here because it's actually going to be outside of this closing costs area. So I will pull down my, let's see if I've got an FHA. There we go. Now I'd want to make edits to these, and Dan, as you noted earlier, actually I'm sorry, that was Dana that noted earlier, it's sometimes rather tough with these property taxes, hazard insurance reserves, because there's no way to just give you a multiplier right now. And the reason for this is we don't know what these escrows are until the screen after this in the wizard. So we can't give you something to multiply against until it's entered in the system. Now that said, we are looking at ways around this. We're looking at maybe potentially changing the screen order inside Edge to allow you to actually have a multiplier instead of entering dollar amounts each time. So hopefully we can get that in there. That's a huge ask, just so you know. It's restructuring the entire wizard, and then we've got to make sure that everything before that is still going to work for you. So I don't see that being worked on right now, but it's definitely been brought to our attention. We're aware of the problem, and we want to make an easier way for you to do it. So we're considering a couple of alternatives for that. For now, you do have to calculate them out. You can actually look at your fee worksheet from your origination system, or if you happen to know what the monthlies are and you know how many months you need of each, then you can just pop those in. So I'll just hit apply to loan for right now. I'm going to make sure to put in my upfront MIP percentage, and then I'm going to finance this into the loan. So my amount financed is going to increase by this $42.21. Last step, hazard insurance and taxes. And then I need to make sure I put my mortgage insurance in there. I do want it to calc on the balance every year, and I don't want it to cut off for the life of the loan. Now, if you're showing tax benefit and MI is still deductible for this year, it's kind of revisited each year. If you want to show it as deductible on your presentations, you just check the box here. Now with this one, we'll do a 5% down ARM. And I'm going to use the copy button to copy that FHA mortgage that I did. And then all I'm going to do is I'm going to change my down payment percentage to 5%. I know I probably can't get 4 1/4. And if this doesn't include the MCC, I would uncheck the box here. But yeah, let's assume I can get it on both of them for now. Now you'll notice that because I use the copy function, it brought over the upfront MIP, which we don't need. So I'm going to zero that out. And I'm actually going to go back and toggle this radio button over to no. Now at this point, I'd apply any additional costs that were part of this. If they were the same, of course, I'd just leave this the same. I do want to eliminate the mortgage insurance, at least the FHA version of it. And I'm going to put whatever factor I can get on conventional high balance or high LTV. And I'm going to uncheck the box because I don't want it recalculating the MI every year based on the balance. And I'm going to get rid of that cutoff month. So now this is saying that this mortgage is going to have $217 in mortgage insurance every month until it hits 78% loan to value. That mortgage insurance is not going to decrease over time like it will on the FHA loan. Now, remember I said we're going to make this an ARM. So I need to do one more thing here. I'm going to change this from a fixed to an adjustable. Now when you do that, it opens up a new screen that has all the caps and adjustment parameters. So for this case, I'm going to assume that this one has caps of 226. Now you can look up what caps your adjustable rate mortgages are using. It's usually on your rate sheet. Matter of fact, it's always on your rate sheet. So you'll see not only the caps, but you'll see which index it's using, and you'll also see your margin on there. So for this case study, let's assume this is a 226 loan. Now 226 means it has the first adjustment cap is going to be 2%. The periodic adjustment cap, meaning how much it can adjust every year, is going to be 2% as well. That's that second 2. Now the 6%, or the 6 at the end of that number of figures, that's actually the life cap. But we're not asking you for the life cap here. We're asking you for the max rate it can go to. So you're going to take and add that life cap to the start rate. So let's put in those figures real quick. Here's where our first 2 goes. That's where our second 2 goes. Now for our max rate, we have a 6, but we need to add that to our 4.5% rate. So our max rate is 10.5. Now the first adjustment month, this depends on how long the ARM is. So for instance, if this is a 7/1 ARM, my first adjustment month is going to be month 85. If this is a 5/1 ARM, my first adjustment month will be 61. So let's go ahead and put in 61 there. Now this question is, how often does it adjust? Now, in this case, I would look at the rate sheet and determine what index it's based on. If this is a 6-month LIBOR, it's going to adjust every 6 months. If this is one of the 1-year indexes, or say for instance the MTA, the CMT, the 1-year LIBOR, all of those adjust every 12 months. So I'm going to assume, because on most of the rate sheets I'm seeing right now, it's 6-month or 12-month LIBOR. So I'll put 12 months. It's going to adjust every year. Now the margin for my rate sheet, 2.25, you're probably going to get something fairly similar to that. And then we need to just choose the appropriate index. So I'm going to go down and choose the 1-year LIBOR. Now floor rate, you may or may not see this listed on your rate sheet. It really only depends on what scenario you want to choose for your adjustments. Now the floor rate means exactly what you think it is. How low can this rate go? You know, we have a max rate, that's as high as it can go, but what's the lowest it can go? Usually it's going to be above the margin because you don't want to cut into the margin. So it's probably going to be around 3% on this one. Now if there is no floor rate on your rate sheet, don't worry about it. It's really not that important. You can leave that field empty. Now the adjustment scenario. This one is something that's pretty important because it affects two parts well actually it affects multiple parts of your presentation. We default this to a worst case scenario. Now you guys can all read the text here when you get the chance, but a worst case scenario is going to tell you, it's going to tell Edge that at that first adjustment month, at month 61, it's going to adjust up the max it can, which is 2%, which means we're going from 4.5 to 6.5. Now every subsequent period after that, it can adjust up to 2%. So the worst case is it will do that. So at month 61, it's going to adjust up 2%. Then every 12 months after that, it's going to keep adjusting up 2% until it hits its total cap at 10.5%, that max rate. So this is going to hit the life cap pretty darn quick. And we're going to end up with the majority of our payments being at the life cap, and it's going to represent a very, very high APR. Now, if you are going to show this, and it's a great worst case to show, I would also advise you show a best case. And the reason for that is when you put out your till, and I heard they're getting rid of that, but when you put out your GFE and your till, you want to make sure that the APRs that you're representing in Edge have a corresponding value over on the paperwork you're going to be putting out with the loan. So if you want to make sure that your APR is exactly the same as what your origination system comes up with, show a second scenario just like this one, but choose best case. Best case assumes that at the first adjustment month, it goes to index plus margin, which is very low, and stays there for the life of the loan. Now, it's completely unrealistic that that would happen. However, your APR that's listed on your docs that go out are based on best case. So if you want to make sure that the APR matches and it matches what your competitors are doing, at least show one best case product here. Now, the worst case, the reason you show them this is you want to show them, look, your payment stream could be best case this, which is almost nothing, or worst case, pretty steep. So I'm giving you all the options here to show you what's going on so you're aware that this could go either way. Now, last step here, I've already got all my monthly escrows, so I'm going to add one more product, and I'm going to make it exactly the same as that 5% ARM. So 5% down, best case. I'll use the copy from button. I'll copy that guy. And then I'm just going to go in and change the scenario from worst to best. All the other stuff is exactly the same, so I don't need to change anything on that. But let's take a look at what this has done over the long term. Now, on a monthly level, both these loans are exactly the same for the first 60 months. Now, when we look at where these guys are going to go after that, and I think I'm getting a little bit of a bug in here. This is the second time that's happened today. I'll get that addressed. But I'm going to generate the live preview. And this is something that will help you guys too. Anytime you want to check your figures, you want to check all this stuff, and you're seeing an odd number like that you don't expect, go into the presentation screen, go straight over to preview, and then just hit the preview button here. This is going to preview whatever's in our database. So regardless of what's in your browser, it's going to show you what our database is putting on this presentation. And as you can see, these new ones are actually saving money because we're offering them, lesser mortgage insurance, really. That's what it boils down to. Now, when we look at these at the 60-month period, they're identical because they haven't adjusted yet. But what happens after the adjustment points? So let's go back into Edge, go back to the analysis screen, and I'm going to change this to be month 72. And we'll just see what it looks like there. Now, when we go back to our preview, this is going to adjust to month 72 pretty quickly, usually about 3 seconds. And you can see that on my 5% down worst case, it's only saving $2,000 over this FHA loan. On the best case, the payment's gone way down, so it's going to save substantially more. And that's only a year later. What happens when we go out 10 years? What happens when we look at 30 years? Things change pretty dramatically at this point. Now, if we want to see it, we can actually look at the payment stream as well. So you might want to direct your client to look at this. The number of payments and where the rates are potentially going to go. This is a worst case scenario, and you can see that it only took 3 adjustments to get to that life cap, and it's done. It's going to have 248 payments at that life cap, so that's a substantial amount at 10.5%. When we look at our best case, you can see what it does. It starts off at the start rate. It's going to go down to index plus margin, which is that 3%, and it's going to stay there for the remaining life of the loan. Now, if we look at the long-term effects of this, let's go back into our analysis screen, and I'm going to put our long-term years at 30, just so we can see what the total interest in MI paid between each of these looks like. And we'll see this adjust in just a moment. There it goes. So naturally, the interest in MI on this worst case, we're paying so much interest over time because we're at that worst case scenario. It's substantially higher than the other ones. But when we look at the best case, this is that 166 as compared to 454. This is just a difference in the interest that they're paying, really. you can see that there's a marked difference. There's a huge variable between what this loan could potentially do depending on how it adjusts over time. Now, what many originators do, and I see them doing this quite often, is there's a third option that you can use for your adjustable rate mortgages. You can actually customize what you feel those adjustments will do over the future. In order to do that, I'm going to add another product. Now, you guys also might want to, you notice I put ARM as the name on this second product. Anytime you're doing an adjustable, you definitely want to have that verbiage in there, so I probably want to include it on that third and this fourth product as well. So I will just call this one 5-1 ARM Custom, or I could even call it Prediction. And then I will copy from, and I'm going to copy either one, because all I'm going to do is change the scenario that it's using. Just go back one screen there. So instead of worst or best, I'm actually going to choose a custom scenario. So I'll select custom, and this actually gives me a grid that shows me what this is going to do over time. So month 61, it's going to start at our interest rate here of 2.83. This is just a fully indexed rate, so we got index plus margin here. Now, any adjustment that is made at month 61 is going to be adjusted to that when you're not doing worst scenario. So as soon as I tab off it, you can see that it changed my rates here. So my first adjustment at 2%, that brings it up to 4.8. Let's say I want to be a little bit more realistic. I'm going to bring it to a 1% adjustment here. And then at month 73, I'm going to bring it up only 0.5%. Month 85, let's say I want it to go down 0.25%. Now you can find out what these indices have done in the past through a couple of different places. The one I like to look at is called MortgageX. It's mortgage-x.com. They have all the historics on all the indexes, on all of the the Fed funds, everything. You can even see just what the Fannie Mae's done over history, so you can get an idea. But it's a great place to go and check out some of the data that they have. You'll find that most of these index values have kind of done this wave type of pattern where they go up and down over time. And there haven't been any that have been real drastic lately. Most of the adjustments are really small, and we don't see anything really hitting its life cap. You know, the big scare behind the ARM is what happens if it adjusts all the way to the top. Well, the fact is, if I took out a 5-1 ARM 5-6 years ago, I've got a pretty good rate right now because it was based on MTA or it was based on one of the LIBORs. Either one is actually fairly low right now. But you can make your predictions going forward. You can even space them out farther. They don't have to be every year. You can say I want to go out to the 10-year point, and at month 121, I'm going to put a full percentage there. And then maybe at the 15-year point, I'm going to push this up a little higher. And then I'll hit OK. Now by using that custom scenario, it's going to be somewhere right in between what these guys are. So as soon as this updates, you'll see that my 454 is the worst case. My best case is 166. And my prediction is it's going to land somewhere in between there, right around 260. Now that is commensurate with what the FHA loan does. And that's because the FHA loan has that MI that lasts for the life of the loan. So my prediction here, it might be a little bit high. I might want to push out a couple of my adjustments so they go out a little farther. Maybe my 10-year point, I'll push that to the 15-year point, push the 15 to the 20-year point, something like that. Or I can make them slightly smaller adjustments. But completely up to you. You can kind of make this look the way you feel it's going to work. Now I will tell you that anytime you're doing an ARM, I mean, it's scary because of compliance. You know, you want to make sure everything's showing there. Now your payment stream is going to show, so you don't have to worry about that. Nice and transparent there. It's always going to be there. And you can see what the payment predictions are for my predicted scheme here and how it's going forward. So there's nothing that's going to be hiding in the background. But I will tell you that you probably want to put some color in the payment notes to explain why you showed these three different options, you know, or maybe put it in your disclaimer text. You can even put it in the more info section here. So this verbiage that goes right here, or even in the short-term section, you can put a little bit of extra color around why you showed them these three different options. Now, with any of these, of course, you can see that I'm saving them $56 a month, so I'd probably want to put that back into the mortgage, and you can put it into an external account if you want, so they can get them a little bit more cash over time. But, as I see it, I think I'm going to put these back into the mortgage and just basically try and reduce the amount of that balance once it recasts on the arms. So if I'm going to do that, I'll go over to the analysis screen, and I probably would have done this before I started copying. That made things a little easier. And I'm just going to go into each one and do 5581. Copy that guy. Now, some of you may have noticed there's a checkbox there called Adjust with ARM. Now, what this does is this actually adjusts your payment here, how much you're doing for principal reduction with that adjustable rate mortgage. So as the mortgage goes up, meaning the rate goes higher, you're going to have less that you can devote towards this reduction payment, so the reduction payment is going to go down. If your rates fall, you're going to have more that you can put towards the reduction payment, and the amount that they're putting towards principal will go up with it. So it's just going to assume that whatever you've chosen here for your case, if it's the worst case, obviously at the first adjustment point, we've got nothing left to do. So this is going to stop at the first adjustment point. On the best case, it's going to continue. And it'll only continue for a little while because eventually we're going to get out of the area we need to be at. But the whole idea behind this is, even though it continues, look at our freedom points. Our freedom points are actually longer on the best case. Now, I'll have to show you the amortization so you can see exactly why, but I'd like you guys to do this for yourself. Go into Edge, create an ARM, do a best case and a worst case, and apply a principal reduction to them. Don't do the adjust with ARM, just so you can understand first how it looks on the amortization schedule, and you can see why it's doing this. It's actually rather interesting to check out. All right, so now all of these, when they recast at the 5-year point, they're going to recast at different balances. Actually, they'll recast the exact same balance because we're putting the exact same amount back into principal every month. And then the following year after that, the next recast point, is when they're going to change, because we have different amounts that we're going to be devoting towards that reduction payment. So in the end, it's every year it's going to keep recasting that payment based on what the balance is. So check out what the amortization schedule looks like so you can get a good idea of how these are represented in Edge, and you can understand how you can explain this to your client. All right, let's see here. Mark's question, he says, on page 3 of the printout, it groups fees. We need to break down the upfront costs versus prepays. These are all lumped together on your report for APR. Do you have any way to break this out so they're able to see how this breaks down? So let's take a look at what Mark's talking about. So Mark's talking about printing, which I do not advise you print this, honestly. I would highly advise you always send the live link. The print, really, I know that there's some people that can't click on the link, and there's going to be a case for when you need to do this. But the print doesn't update. So when they go to print this, it's a one-time shot. Or if you print it and send it to them, it's a one-time shot. You can't just resend it to them without now dropping a new piece of paper in the mail or something like that. So I would highly advise that, get this on the live version so they can actually get the fee detail breakout. All right, so what he's talking about here, and I'm assuming this is the part here. So it groups the fees, but these fees are a little bit different from what you'd expect, Mark. These are not just APRs or non-APRs. What this is doing is this takes out, it looks at APRs, non-APRs, and then it doesn't include any of the prepaid items. They're not in here. So if you mark a PPE checkbox, it doesn't show up in this figure here. So that's one way you might be able to get around it. Now, the best way to see the breakdown is page 4. I mean, this is really, that's going to be the best thing, but you've got to make sure that you're doing the line itemization, or you're just going to get, the ballpark fees on this area too. But this is where I would direct your client so they can see what these are. Now, you can see that I've got none of these labeled as prepaid escrows, and that's because I used kind of a crummy template on this one. But had I used one of my other purchase templates, I would have had a couple of prepaid reserves on here. Those would be marked prepaid escrows, and those would not be included in that closing in points area. So hopefully that helps there, Mark. Let me know if you need a little bit more detail on that one. Okay, so Diego's question kind of similar to what we heard earlier about how do we enter the reserves. So if you're impounding county tax, which is what his question was, let's go to any of these guys and I'll just break open the template and show you. So the best way to do it is you're actually going to want to calculate what this is. Remember, we can't give you a monthly multiple because we don't know what the monthly tax is when you're in this screen. But you can see I've got my county property taxes. That is a prepaid escrow item, and you would just put the full sum of whatever it is in there. So for instance, if they have 6 months of property tax, you need to calculate what 6 months is of their monthly tax and pop that in here. Just make sure you do check the box here for prepaid escrow so it doesn't alter their short-term savings. Dana's question, can you please show us how to set up a template? Absolutely. So this is actually a good one to use. Let's see here. I've got most of my stuff on here. Well, let's put in my tax reserves. Let's say it's about $750. And a year of hazard insurance reserves. You notice this one is actually a custom fee. You can create custom fees anytime you want. If the names that we're using in the drop downs they aren't identical to what you want your client to see, you can always add a custom fee. Hit add custom fee. That way you can call it anything you want. You can tell it what to calculate on if you're going to use a percentage, whether it's on the loan amount or the property value. You can tell it if you want it to be a default prepaid escrow, if you want it to default as an APR item, and then you hit OK, and it's in there, and it's selectable from then on out in your drop-down menus. So you can see that if I go down to the very bottom of my drop-down menu, I've got a lot of custom fees in here. So I've got lender credits, MI buyouts, payoff credit cards, resub fees, all kinds of good stuff that could be in here. But feel free to create custom fees anytime you want to. But the short answer to your question, Diego, is you're actually going to want to calculate it and put in the dollar figure there. Now, how to set up a template. Now, once I've got this ready to roll, and I want to say this is a template, and this is probably before I start calculating things like my tax reserves and my hazard insurance reserves. I want to say this is a template with those zeros in there. So what I would do is I'd probably erase this for now. And I'd look to see if there's any other variable fees in here that I would need to change every time. And it looks like the only one missing for me is going to be my loan origination fee. So I'll put my loan origination, and I'm going to leave it blank because this is going to change depending on what the loan amount is. So if you want, there's actually one that I did for somebody else. I did a purchase loan origination. Let's see if I've got it in here. Ah, there we go. I created a custom fee called loan origination fee, and the reason I did it is on a purchase, if I want to just do a 1% origination fee, I can do that, and I can save this to the template, and it'll be just fine. You don't want to use this on refis. That's the reason we've graded out on the main fee, is because when you do this on a refi, this 1% is 1% of the total amount financed, but there's checkboxes here that allow you to add fees in. So when you're on this screen, Edge doesn't know what the total amount financed is yet, and it's going to look at just the base of loan amount before you've rolled in any fees. So I would tell you on refis, you never want to use this percentage for loan origination. But on purchases, you're not going to finance any of the fees, so feel free to use it. So I actually created a custom fee, called it loan origination fee, and left a 1% there. Now, once I'm happy with the way this guy looks, I'm going to hit Save as Template. And then I'm going to call this one FHA Purchase. Now, if you want to make it available for certain states, you can choose the state that you want it to be available for. If you don't choose a state, it's available for all states. So I will leave the state field blank. And then I'd probably want to go back in and fill these guys in. I think that one was supposed to be the 750. And then I'm going to apply it to the loan. Now, what got saved to the template is right here. So let me save that to the loan real quick. And let's go back to the settings, and I will show you exactly what that did. So now if we head over to the fee template screen, you can see that we've got a bunch of them in here. And this is the one we just saved, FHA Purchase. All my figures are there. You can see the ones that I left blank because those are the ones I need to edit on a case-by-case basis. Even my loan origination new fee is in there. Now the good part about this is now anytime I want to use this fee structure, all I have to do is I'll go back into that sample file again. And let's say that I wanted to use this one for my 5% down arm. I'm going to go to the closing cost screen on this one. And then all I'm going to do is select it from the drop-down. There's my FHA purchase. It's already filled in everything for me. All I need to do is put in those calculated reserves. So what was that, 400 and 750. Everything else is right in here. I can now apply it to the loan. So that was a quick and easy way to take an existing file that I was working on, turn it into a template, and have it immediately available for any new products that I'm working on. Now remember which fields you're going to want to leave blank. On a purchase, you're going to want to leave the hazard insurance reserves, the tax reserves, MI reserves if you've got them on there. Basically, those are the three that are going to vary. Your loan origination, if you use the stock loan origination line item that we give you, you want to leave that blank as well. But if you use a custom one like I showed you, create a custom so that you have that percentage open, you can enter a percentage in there so you don't have to worry about your origination fee on purchases. Just make sure that you only select that on purchases. All right, so let's see what other questions we have before we continue on here. Okay, Shannon's question, when I update a scenario, must I hit generate link so that the customer can view updates? Not quite. But it's always a good idea to go in and hit generate link anytime. That used to be the only part that saved one of the iterations to history of what your presentation was. So it was a good habit to get into. But we recently modified this so that anytime you exit your client, so if I'm on this sample file right now and I go to a different file inside Edge, it will change, it'll save my historic changes. Now that being said, you don't even need to do that much for your client to view it. For your client to see your changes, all you have to do is hit a right or left arrow. So either of these arrows inside Edge, as soon as you do that, if your client already has the link, it's going to take about 3 seconds and their version is going to update on its own. So you don't need to resend the link. You don't need to go back in and hit generate again. As I said, the only reason the generate link there, the whole generate link button is there for you is so you can get that link for the first time, and it used to be the point at which history was saved. But now if we look at history is no longer based on the generate link. So I've already generated a link, but I haven't changed anything on this file, so there's no change log here. So short answer on that one, Shannon, you don't have to generate link. Just hit the right or left arrows, it'll automatically update the live link. Steve's question, when the link takes the borrower back to the Mortgage Coach home site rather than the presentation, or it says presentation cannot be found, is this a common error? So what that is, Steve, is it could be happening for one of two reasons. One, if the actual file was deleted inside Edge, the link would no longer be valid. Two, if the link is not pointing to, if it's missing a character or something when you paste it into the email. For instance, if I take and generate this link right here, and then I copy it, and let's paste it into a browser. Oops, didn't catch that, did it? Let's go back and copy that again. So if I paste this into a browser and I eliminate one character from it and hit enter, it's going to give you this. It's just what you're talking about. It just redirects you to the Mortgage Coach site. It's because something's missing in the link. Either that link is missing a digit on the end, or that client has been deleted inside Edge. So as long as you know the client's still inside Edge, what I would do is go back in, hit generate link again, and just compare the link that you've got versus the one on the email. I have a feeling they're slightly different. But if you run into that and that's not the case, where your email link matches directly what Edge has in it, shoot that over to us and we'll check it out for you immediately, Steve, and make sure that we can get it resolved. All right, and it looks like we are right at the end of our hour today, so I think I'm going to let everybody go. Thanks for joining me today after New Year's. I know it was really rough for me to get up this morning. I'm sure it was a little difficult for you guys as well, so I do appreciate you coming in. Great questions today. I did record this presentation, so you can view this presentation later today. I'll have it up in the Coaching Call archive here, and feel free to email us over at support if you have anything that you'd like help with. Thank you very much. Have a wonderful day, everybody. Bye-bye.